Good Monday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent. How was the weekend, buddy?
It was pretty good. A little bit. It was relaxing. Actually pulled out a book. Did I ever tell you I went to see Alan Greenspan speak? Like, he wrote a long time ago, wrote a book, like, after he left already, the Federal Reserve. You know,
I remember that. Where'd you see him? In Philadelphia somewhere, at Penn or something?
Yeah, in Philadelphia. So I have, an autographed book by him. So yesterday I started opening it up, and maybe I'll discuss some of the points he was making, because it was something that Warren Buffett kind of said over the weekend. Warren Buffett, they gave their earnings reports, and he always gives some insights into in investments, the markets, and the economy overall. So I think maybe I'll mention some of the key things that I think he said were interesting, important to keep an eye out, really dealing with, like, macroeconomics and inflation. So maybe we'll go over that. But, just so everybody knows, if you guys are new to the show, we do the show in the mornings, every morning, to help answer any questions you may have about the Market Chameleon tools, data analytics. Also, if you have a question about a certain strategy or something you've seen that's unusual, you could ask that question directly. We provide a link to Zoom, and if you click on that link, it takes you to Zoom. There's a button, raise your hand. Click on that button, and you don't have to turn on your video camera. Once we let you in, everybody could hear you. You could ask your question directly. If you prefer typing in a question, you could also type that question on the live chat on YouTube. Will's watching it, and he'll read it back to me. But I think what I'll do is, while we're waiting for questions to come in, we'll take a look at the pre-market report, see what's trading at pre-market hours, try to get some insights, and then I'll move on and maybe mention some of the things that I think Warren Buffett was talking about, and maybe kind of discuss it from from an inflation macro kind of point of view.
Cool.
Sound good? All right. So pre-market trading, these are stocks that are trading in a pre-market hours. We have a list of our most active stocks, our biggest percentage gainers and biggest percentage decliners. Coming down here, and I see 110 stocks made our percentage gainers list, 42 on our percentage decliners list. And from this perspective, looks like we're lining up as a bullish bias at the open. And, when we look at this list, you'll see stocks that are small cap stocks. You'll see ETFs in there, leverage products, closed-end funds, really anything that's listed on the major U.S. exchanges. If it's trading in pre-market hours and it meets our thresholds, it can make this list. So we want to narrow down the list to a smaller group of stocks to get better insights. And what I usually do is just start out with S&P 500 stocks. To do that, we could use the filters above. Here's an ETF. I drop it down, get a list of ETFs to choose from. The top one, SPY, that's the S&P 500 ETF. When we select that, let's do that now, you'll see the list below get filtered by stocks that are holdings in the SPY, which are the S&P 500 constituents. And here we see 21 stocks made our percentage gainers list, 4 in the decliners. So from this perspective, right now we're lining up for a more bullish bias at the open. Let me see if there are no questions. Will, maybe what I'll do is, navigate to SPY, get some insights, talk about some of the things mentioned, over the weekend.
Perfect.
All right, I'm gonna go to SPY. I'm gonna bring something up. These are on the fundamentals. And one of the things, at least, I like to look at, other people may or may not look at, but it's the spread. I'm going to come down here, and it's the spread between the earnings yield or operating earnings yield in the S&P 500 and the risk-free rate. And what this is if we think of it this way, if we bought if you had enough cash, right? If you just had enough cash to buy all the stock in all the S&P 500 companies, well, you would own all of those companies, and then you're entitled to all the earnings. And if you took the cost of purchasing all the stock, paying off the debt, you own it outright, and you kept all the earnings from operations, then, and we're basing it on the trailing 12 months, then the yield is 5.6%. Okay. And when we compare that to the risk-free rate right now on the 2-year, you're getting close to 5%, 4.8%. So you could see that the spread here keeps narrowing, right? The spread between the risk assets and the risk-free assets keeps narrowing. Here's the 2-year. Oh, let me see here. Okay, here's the 3-year average. So you can see in the 3-year average, you got 5% versus 1.3. And I like to look at the 2-year here. And on the 5-year average, you got 5.2% versus 1.7. So this is a very narrow spread. You can see less than 1.8%. And this is where, when we look at it, we hear about, well, the multiples are, right now on a relative basis, the market is expensive. Multiples are expensive. And that's what it does seem like from this perspective, this type of, comparison. So it's looking at risk-free rate versus the earnings yield on the entire S&P 500. And a couple ways right now that the S&P 500 companies return that yield to you. One is they could take the earnings and give it to you in a dividend, right? So you got a dividend yield of about 1.7% right now. That's
Hey,
all. Yeah.
Lawrence is asking a question about the topic. He said, shouldn't the dividends be added to the operating yield?
Right. So this is prior to dividend. The operating, this is prior to them paying dividends, right? So this would not be, so, first you make a profit, then what do you do with that profit? So that's what I'm getting at. Out of this 5.6%, some of it, right? What are they doing with this money? Well, some of it they're giving it back as a dividend, right? So this 5.6%, first you have to earn it. So what do you do with it? Well, we could see that some of it is going towards dividends, basically cash given back to investors. Okay. So think of it this way. You have a piece of real estate. You paid it out. How much did you earn on it after expenses? Well, you earned, $5.60 for every $100, right? And then what did you do with that $5.60? Well, some of it you gave away as dividend, right? So that the amount of dividends received divided by the stock price would be 1.7%. Okay. So that, think of it this way. It's not added to that. This what happens with this money, then we have to subtract it out. Another way that what companies are doing is taking some of that money, right, that they're earning, and doing stock buybacks. So instead of giving the money back to investors, they'll say, okay, if I give money back to investors as a dividend, well, there's a tax that the investor has to pay, right? So right now, if you own the stock, you get a dividend. Well, you report that, you report that to the IRS, and you pay a tax on it. So companies then look at it and say, well, what's another way that's more tax efficient is to just take that same money and buy back your own stock, right? So instead of giving you cash and you pay a tax on it, they'll go in and just buy back the stock. And by buying back the stock, in a way, they're returning money back to you, because artificially they're creating demand on the stock, right? So they're taking supply out, they're creating demand on that stock, and you could say your earnings per share or whatever goes up over time. And this is happening. Actually, the stock buybacks right now, I believe, are 2 times the dividend payments. So I believe that the S&P 500 dividend payments add up something to, like, between 500 and 600 billion dollars. Okay, so think of it, companies are $500 to $600 billion. They're just giving back cash to the shareholders, and about $1 trillion they're using to buy back stock, which creates this, demand on the stock. It's like inflows into the stock market, right? Because what they do is they give it to a broker and they say, here's our program. We're buying this amount of dollars worth over the quarter, and whatever broker's handling it, they're going to VWAP it and say, here, you bought the stock at an average price of this, right? So it constantly creates inflows into the stock market. I would say that type of inflow is non-fundamental. It's not somebody who's looking at a stock price and saying, wow, well, this stock's underpriced. I'm going to buy it. It's more like that's just a return of capital. So, it could be debated. Are they doing it because they think that their stock is really undervalued? Because most companies always think their stock's undervalued, right? Management always thinks that. So, so that's a source of inflows that if you guys follow what's going on, it started to get taxed this year. So the US government took a look at it and they said, well, they don't believe, okay, there's a debate. They don't believe that's an efficient use of capital, because they think that, well, that capital, instead of buying back shares, you could have used invest in productivity, invest in something that there'll be future benefits. So they don't see that as an efficient use of capital. And this year is the first year that they started taxing the practice of buying back. I think it's 1%. And now it didn't impact, I don't think it impacted the buybacks at all. So we might be seeing even higher tax rates on the stock buybacks. And there's a debate, going on, is that, I think Warren Buffett actually mentioned that he thinks stock buybacks are an efficient use of capital. But there are people making the opposite argument, saying that certain times there is, certain times, like if you think, maybe if you're diluting your shares, they go through this whole thing where there are exemptions. If you're diluting your shares because of, employee benefits, you issue them stock, you can buy back. There are exemptions to it, but the practice of just taking profits and buying back stock right now, the government is looking at it that is not an efficient use of capital, that they didn't think, and I think they're gonna start taxing it higher. What do you think?
It does feel that way, that's for sure. Certainly the Reddit, I mean, the comments out of Washington seems to lead to that opinion.
That they want, that they're like either pay it out as a dividend, so this way the government collects taxes. All right, so if they pay it out as a dividend, at least the government collects taxes from it, or use that money to hire people, make investments, into technologies or improvements going forward, because they want investments. They want these companies to make investments to increase productivity. So those are ways that that companies are returning cash from these operating yields. But you could see here that this is coming. This spread between here and here is very close. And by the way, there are a few inflows into the market that I would call non-fundamental, that they're just continuously inflowing. I think we talked about this before. 401ks. When people are employed, right, and there are a lot of jobs out there, there's a tax incentive to take some of those earnings, put it into an IRA, and invest it into the market. Okay. And this is happening, because of these tax incentives exist. Otherwise, these people probably would never have, bought these stocks. And about, I think, like 30 to 35% of stock ownership is in the retirement accounts. That increases as employment goes up and as salaries go up, right? So right now we're in that situation, low unemployment, salaries going up. So the flow of money from there and from buybacks, continues to go into the market, pushing it higher. And of course, right now we also, the IPO market, the supply of stock has decreased like significantly from, I think, like last 2 years. It's been just, significantly going down. So that pushes stocks up, which I think has less to do with fundamentals, more to do with just supply and demand and natural influence. But what I wanted to touch upon is that, I think that if these get inverted, there's going to be, I think that's going to create a problem, and again, how do they get inverted? Stock prices could go up, this comes down, or the Fed just keeps raising interest rates. And the question is, will the Fed continue to raise interest rates? And Warren Buffett brought something up, but before I even get to that, I just want to show you, what the Fed is looking at. Like, here's the CPI numbers, Consumer Price Index, and over here, all items here, they say, if I'm hovering over it, year over year, it's up 6.4%, and month over month, up 0.8%. Then they seasonally adjusted. And I brought this up because that's the top number, but here's the breakdown, right? So they give you a breakdown of where it's coming from. So these are all items all the way up top. Then they give you a breakdown. Well, there's food in there, there's energy, you could keep going down the list, what they look at, and then they break it down even further. And I wanted to show you this, and they even give it a relative importance. Food, that's the importance, 13.5. They give these weightings of relative importance. And when the Fed is looking at this, there is a top number, 6.4%. But when you look down the list, you see, when you keep looking down the list, all these numbers, no matter where you look at, are up, which has shown that the inflation right now, it's just widespread. Maybe this one stands out. According to them, used cars are down. But out of everything else, when you go down the list, everything here just keeps pointing up, right? Which is a big problem, for the Fed. When they see this, they can't look at this data and say that, we're going to stop raising interest rates, or we think that, we're done. And we're right now at what's the Fed funds rate, Will?
Is it
4
4.25?
I think it's higher than that, isn't it?
4 3/4?
Something like that. Yeah. So, are we going to 5.5? And I'm showing you this because we're already
4 3/4.
4 3/4. Right there. 4 3/4. How close we are already to this, to where the S&P operating yield is. In my opinion, like if that gets inverted, that's going to create a lot of problems, because basically what you're saying is the government itself is going to pay me more money on a risk-free asset than I could earn, investing in risk assets. That at that point you really have to, people really have to, why am I doing it? Maybe you expect super growth or whatever, but I think that once you get inverted there, you're going to have to be like, and if this continues. So one of the things Warren Buffett brought up about inflation was deficits, right? And if you guys, after 1929, if you guys know the stock market crashed, there was a Great Depression, and then Keynesian came out with this economic theory that a lot of our models today follow the logic of that, the Keynesian economics. Okay. And the Keynesian economics say, and I'm trying to simplify it as much as I can, that if you're in a situation where there's deflation and high unemployment, it's okay to run a deficit, for the government to run a deficit, because it needs to stimulate the economy. It needs to create demand, right? And they did try that, and it works, right? They tried, the government ran deficits, borrowed money, build roads, and in situations where there's a recession, there's a increase in unemployment, and there's deflation, the government can run a deficit and spend money to boost demand. And prior to that, the theory was leave it completely alone and it will always come back into balance, right? Leave the economy alone. You're going to have recessions. You're going to have, you're going to have times of booms, but the economy always works itself back into equilibrium. So then they have this now a new model that you could run deficits during periods of recessions and deflation. Going forward, they had to then amend it, because then we had in the 1970s, I think it was 70s or 60s, where we had unemployment and inflation, which didn't make sense, because when you have unemployment, you think there's a recession, prices come down, but what you had was inflation. So then they created, this inflation expectations, whatever. The model gets tweaked. All right, I don't want not too much, but when we follow Keynesian, if you follow that model, what needs to happen is, if you're running deficits during periods of recession and higher unemployment, you have to run surpluses when you're at full employment and there's an economic boom. That's how it works, right? So the deficits have to be followed by surpluses. In other words, that when the economy is at full employment and your economy is growing, GDP is growing, the government has to scale back on its spending or raise taxes to run surpluses. Okay, so you need deficits and surpluses. And with Warren Buffett, when he's talking about inflation, is that right now we have endless deficits. So let me show you here. There's the budget of economic outlook, right? These are deficits. So what's a deficit? Deficit, it's not like debt. Debt is what totally you owe. A deficit is this year, if I'm going to bring in, $100 million in tax revenue, but if I spend 150 million, then I have a $50 million deficit. I spent more this year than I collected this year. So that 50 million is going to be added on to that debt, right? And here you could see that we've had downturns and economic booms. From 2000, we had a lot of, we had, 2008, we had some downturns, but we had economic booms. But we've always run deficits, and the projection is we're going to continue to run deficits all the way to, so far, wherever they projected out to 2030, of $1 trillion a year. And that, and I think what Warren Buffett was saying is we had a surplus here, but since 2000 we haven't. And that's not sustainable, because if you continue to do that, then you risk hyperinflation, right? You can't continuously just run deficits. There are periods when we need to run a surplus. And right now, what's happening is that when you look at the government budget, nobody wants to cut anymore. Both parties will look at each other and say, okay, well, we're running a deficit. We should be running surplus. But nobody is courageous enough, because they're looking at each other and say, well, are you going to cut Social Security? Because if that's your proposal, why don't you propose it, put it on my table, and I'm going to go on TV and tell everybody that, this politician wants to cut your Social Security.
Yeah, the great news now is we're at the, doorway to a world war, which is going to cost some more money, right?
Right. And the only place really, like, maybe you could cut is the defense budget, right? You could say, well, we spend more than all the other everybody else in the world combined, or whatever it is.
Yeah, for 30 years it felt like we lived in a real safe world, right? And now it's
so now we're adding to the defense budget, right? Because we're supplying aid, military aid and equipment that will need to get replaced, right? And the military is going to require a bigger budget than before. So what's happening is that, and I think this is what, I'll go back and read maybe more carefully what he's, but he's saying that, look, even Berkshire Hathaway maybe offers some cushion to inflation. They have assets and stuff, but this here, when we're looking at it, you're like, okay, going out forever, this is not sustainable, right? It's not sustainable without creating inflation, right? It's not sustainable without, hurting the dollar strength and creating inflation. And as you could see here, not only did we, from here to here, from 2000 to here, we had a lot of up cycles. We haven't gotten to a surplus, and now the projection is we're never going to get to a surplus. And it's going to take a brave politician, or both sides have to come to agreement and say we're going to take a hit with the voters, but we got to start raising taxes and cutting spending to get back into surpluses, because in the long term it'll create a healthier economic system. Well, we're right up at 9:30.
Yeah, everyone was super impressed with your discussion. It was awesome today. Thank you. We did have two questions, and I'll send them over to you. They were from newer chameleons. Eric was asking, what's your insight on LSA Life Storage, as well as Intel considering cuts to its dividend? maybe you could look at that. Someone was also asking about AEHR. I'll send those over to you. Maybe we can look at them tomorrow. Awesome job, my
Okay.
friend.
All right, everyone. Thanks for joining. Stay safe out there. Have a great trading day. Hope to see you guys tomorrow.
Great job, D.